Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Wildfires plunged Los Angeles into a worst natural disaster in decades, with hundreds of thousands of people being evacuated from Hollywood and other neighborhoods, and even spurring Joe Biden to cancel his final foreign trip as president. And 10-year gilt yields hit the highest since 2008 as the UK government's fiscal challenges grow, and Chancellor Rachel Reeves faces pressure to restore fiscal headroom. Plus, China ending 2024 with near zero inflation despite a slew of stimulus measures, highlighting the persistence of deflationary pressures from the region. Lizzy.
Well, Kriti, welcome to Thursday. Checking in on these markets, and we do have US stocks closed today for President Jimmy Carter's funeral. Treasury's closing early, but you're looking at a 10-year yield that's been marching closer to 5%. 4% now is where we are, but the global bond rout infecting long-end gilt yields and cable now at its weakest since November 2023. Euro Stoxx 50 futures, meanwhile, pointing lower, but your FTSE 100 futures actually showing a little optimism today. The countdown to the opening trade starts right now.
Thursday the 9th, good morning. American equities will be closed today. The United States honouring its 39th President, Jimmy Carter. His funeral will take place a little later on, and as a result of which, we don't have the US playing into the global financial markets today. That will have an impact as the session works its way through the day. Here in Europe, we're very much focused on 8 a.m., not because that's when European equities are going to open, but that is when gilts are going to be open. And Lizzy, we're on tenterhooks. We're already seeing some weakness in the pound.
We are seeing that weakness in the pound. As I say, the pound falling to its weakest against the dollar since November 2023. You'd already seen the 10-year yield the highest since 2008, the 30-year inflation link rate at 2022 levels. Now, yesterday we had the Treasury issuing this rare statement, so reaffirming the Chancellor's commitment to her fiscal rules, signalling to us that if it came to it and there was no headroom left, she would choose spending cuts over more tax rises. But now the question is this a replay of 1976 or a Liz Truss moment? And is she going to come back and try and intervene again if the market moves about?
Is this Callaghan or is this Truss? In some ways, this feels more structural. In some ways, this feels more problematic for the UK, maybe even more so than the Liz Truss moment. It's going to be fascinating to watch how the market deals with the prospect of an austerity budget, which could ultimately slow the UK economy down even further. Labour came into power talking about growth. That feels like it's an evaporating story.
Well, Labour came into power saying that they were fiscally responsible, in contrast to the Conservatives. Post-budget, Reeves has said that there'll be no more tax rises, one fiscal event a year, no return to austerity, and she'll stick to her fiscal rules. Something's got to give.
When we look at the market reaction, though, off all of this, I mean, the momentum that you've started to see in the long end of the curve, it's starting to have a ripple effect throughout the rest of the world. You've seen this in the Treasury market. You're seeing it in European markets as well. We were talking about this before the show as well. Is this a UK story or is this a European story as well? Because if you start to look at the spread between the UK debt and, say, German debt, for example, you're almost to a 1-2 standard deviation move. We're getting into panic territory.
The UK has an inflation problem in the way that Europe in some ways doesn't, and that's the real challenge here. Leaves the Bank of England in a difficult position because it can't cut rates in the way that maybe we would have anticipated in this kind of a scenario.
Well, the Bank of England doesn't want to look like it's being led by fiscal policy.
Fiscal dominance, yeah.
Exactly. The last time when they did the intervention post-Liz Truss, there was the LDI crisis. We're not there yet. So what is it that would push the Bank of England to step in and do something?
And, of course, making those borrowing costs, even for companies, much, much trickier. And this is something you're seeing in the rest of the world. It is a truly global story, except for in the States. This is where you're perhaps seeing a little bit of a different story when it comes to at least the U.S. bond market as well. Initially, my first read was that this is kind of the tail wagging the dog or dog wagging the tail, and that the U.K. move is showing up for the rest of the world. But then you have to factor in, we heard from the Fed minutes as well yesterday over in the U.S., really saying that now they're close and kind of confirming what we already knew, that they're closer to maybe not moving at all, that they're at where they expected to be in terms of kind of monetary policy easing.
The minutes validate in some ways the more hawkish stance that the market has taken and the pricing out of cuts. What I think is still interesting, though, and this is what I think ties back to the UK, is that since the Fed has started cutting, long-end rates have gone up. That's hugely abnormal. This is not normal behaviour by a bond market. And that speaks to the challenge that the UK faces and the United States faces. So maybe that's the line that you can draw between the two. This is happening at the long end in both places, and it's a big move. And it's contrary to what you are seeing at the front end, which the Fed, Bank of England, etc., can control.
Well, like Rachel Reeves stepping in, we've heard from Janet Yellen weighing in on the spike in yields, saying that the strong economic data suggests that, yes, the rates path ahead is going to be a little higher than expected, but the term premium has begun to normalise. So, like Reeves, trying to calm things down, perhaps.
Yeah. Has Reeves done anything to calm the situation down? I think we're going to find out at 8 o'clock as to whether or not that is the case. Let's turn our attention to what is happening in China.
The opposite.
Yeah, exactly. So you think about what is happening around the world. We've got an inflation problem. You've got a high yield problem. China has the exact opposite. 0.1 on headline CPI coming through this morning. This is a deflationary story. We're getting down towards zero. This feels like kind of Japan 2.0 in so many ways. And what is clear is the stimulus that has been delivered thus far has not had the impact that the authorities were hoping for.
And this is where I think the ripple effect is so crucial here, because we've been waiting for kind of that read-through. Well, we talk about this in the European playbook a lot, but we've been waiting for that read-through into the U.S. inflation numbers as well, that if you see China export deflation to the rest of the world, is that the solution to some of the inflationary pressures that you may actually see? And there was actually a really interesting take that maybe the UK is the best beneficiary of it all from the China story, because that's really where you could see kind of the almost insulation from the consumer story, but still when it comes to trade flows and exports, it shows up right here in the UK.
Yeah, it also adds the case of the PBOC to ease, but then you've got that conflict, of course, with supporting the yuan, and then you talk about the trade story. Of course, there is another blow to markets in China for Biden with our scoop and his kind of last-minute 11th hour round of restrictions to keep America only exporting AI chips to friendly countries, and that will knock Nvidia.
This feels like an incremental story, though. This is just another layer of restrictions that are being applied into the chip space as it becomes increasingly clear the technology space is diverging into two distinct camps.
And what it does basically at the end of the day in terms of actionable plans for these companies is you just have to make one version of your product for one country and one part of the world and one version of your product for another. And we've seen Nvidia be able to do that because they're sitting on lots of technology, lots of talent, lots of cash. Can the likes of other chip makers do the same? I'm not so sure.
I think the real, if you take a look back at what has happened over the last few years, the surprise has been that China, the effect has been not that great, that China has found a way to deliver on some of this technology. There have been heavy restrictions in so many places, but China has managed in some shape or form to be able to continue to develop. And I think that's going to be the challenge for the Trump administration. Let's talk about all of this. Let's talk about our guests. Let's talk about what we're going to be talking on during the rest of the show. Carl Emmerson, UK Institute for Fiscal Studies Deputy Director, is going to be joining us. Yep, we're going to be talking about what happens next, what Rachel Reeves, the UK Chancellor, can do. Bilal Hafiz, Macro Hive CEO and Research Head, is going to be joining us. Hussein Sajwani, DAMAC's founder and chair, joining us out of Dubai, talking about a big announcement that was made earlier this week in the United States. Looking forward to hear that conversation a little bit later on in the programme.
Well, here's what to watch out for today in terms of the markets. We have US cash equity markets closed, futures and bonds closing early. This, of course, because it's Jimmy Carter's funeral today. Then at 2:05 p.m, the Fed's Collins speaking, and at 4 p.m, the Bank of England's Sarah Breeden speaking. But, Kriti, I just wanted to say I came across this lovely quote from Ed Yardeni on President Carter. He said, "The New York Stock Exchange closes when presidents pass away to demonstrate that capitalism couldn't exist without a democratic government." There really is a beautiful sentiment in the market closure today.
There is, absolutely. And, of course, this is going to be something that I think hangs over a lot of the politics that we're talking about, a lot of the markets that we're talking about as well. This is a man, in terms of his legacy, a lot of people talk about his post-presidential legacy as well in terms of Habitat for Humanity, in terms of some of the humanitarian projects him and his organization based out of Georgia really had on the rest of the world. But he's also so crucial right now. Kind of ironically, the timing couldn't be clearer in terms of some of the policy when talking about things like the Panama Canal, talking about things like the approach towards Russia, towards Iran. A lot of these things that we're dealing with now really started under the administration of the 39th President, Jimmy Carter.
Take you back to the conversation we were having right at the beginning of this show, talking about what was happening in the 70s. Carter was in the midst of all of that. He dealt with some of the most difficult scenarios that presidents of the United States have had to deal with. What was happening, obviously, with the energy crisis was front and centre in that period. He had to deal with the Iran story. He had the echoes from that era into what we're dealing with right now feel really relevant on a day when we honour what he delivered back in the 1970s as the 39th president.
And of course, Fed watchers will know this is the president who put Paul Volcker in charge. He put them in the driver's seat to address some of those economic challenges and perhaps to kind of create his own unpopularity in that he was one of our only one-term presidents in history because at the end of the day, the economics didn't work in his favor.
The challenges were absolutely enormous that he faced. And as I say, echoes maybe familiar at the beginning of 2025 coming through. Let's talk about what else you need to know this morning. Some of the other headlines. Jefferies has reported profits that soared in the fourth quarter. We've seen a rebound in M&A and a surge in equity trading revenue. Signs maybe that Wall Street's deal-making slump is finally coming to an end. Net income more than tripled after a 73% jump in investment banking fees and a near doubling of advisory revenue. The strong results, of course, come before the biggest Wall Street banks report earnings next week. A union representing US dock workers has reached a tentative deal with port operators for a new 6-year contract, thus avoiding a possible strike on the East Coast and the Gulf Coast. Bloomberg has learned the agreement guarantees union jobs when certain technologies are implemented, including these semi-automated cranes that has been a key sticking point in these negotiations. This deal still needs to be formally ratified by the two sides. And uncontrolled wildfires are still burning through parts of California, fanned by hurricane-strength winds. The fires have killed at least 5 people and forced more than 100,000 residents to flee. The full economic impact won't be clear until the flames are contained, but AccuWeather has estimated the damages and economic losses could range between $52 and $57 billion, saying it could become one of the worst wildfire incidents in California's history, America's history. And the numbers are substantial. We're already talking about a significant loss of life, which we should all mourn, and also the economic impact of this is becoming really substantial. And the tail effect of this, in terms of the insurance industry, is something that I think will have a lasting consequence.
And we're seeing, of course, live pictures there. It is, of course, I believe, I'm trying to do my quick math there, nighttime in Los Angeles right now. The evacuation orders have now gone, to your point, Guy, to Hollywood Hills. So now hitting some of the more kind of urban city centers, whereas earlier they'd kind of started a little bit outside of L.A. as well. You mentioned the liabilities there. Liabilities crossing almost $1 trillion, that threshold when it comes to it. And this is coming in a context where so many kind of private insurers are choosing not to insure these parts of the country. California, Florida, North Carolina, the ones that are more exposed to climate risk. So I actually saw an interesting stat here that you have to now, if you live in this area, go to this thing called last resort insurance, which basically means that you get have to pay a higher premium to deal with the likes of this. Those kind of last resort plans, in the absence of that coverage, have doubled since 2018. That's a really big deal in terms of national and insurance coverage for this area.
We should also say that President Biden has cancelled his trip to Rome that he was due to leave for today. It was his last planned overseas trip, but because he's having to deal with this human crisis in California. But it also kind of speaks to the geopolitical dynamic because, of course, Meloni went to Mar-a-Lago. So did she offend Biden in so doing?
You do wonder about that. Back to what we're seeing on our screens in front of us and the fires that we're watching. This is, to your point, Lizzie, this is a human crisis. But to your point, Kriti, it is a financial crisis as well. And this is going to be something that's becoming increasingly problematic. It's a problem in the Carolinas. It's a problem in Florida. It's a problem in California. How do you insure this stuff? Can you insure this stuff? You're seeing unregulated insurers coming into the market. That's hugely problematic as well. Are we going to have to, at some point, see a shift in behaviour? Can you live in these places anymore? This is a huge urban area that's being affected here.
And how does the federal government deal with it? You mentioned the hurricanes in North Carolina and Florida. Remember, they're still dealing with disaster relief funds, still have not made it to those areas off the back of disaster relief funds to wildfires in Hawaii. So now, how much is this going to cost not just insurers and the people and their livelihoods, but also the federal government? This is going to be top of Donald Trump's agenda, which he's already been making comments around things like water supply in California. We're going to give you the latest as we see the story progress. Of course, stick with us on that. But coming up on the program, Gary Gensler says there's still more work to do on crypto regulation. We're going to bring you our interview with the outgoing SEC chair later in the show. Plus, a new report shows hiring by British businesses falling to its fastest pace in 16 months. We're going to discuss what it means for UK Chancellor Rachel Reeves and the Labour government. But up next, we're joined by Ava Sun-Wai, fund manager at M&G Investments. We're going to dive into this UK Gilt story, U.S. Treasury story in there as well. If you have any questions of your own, get involved in the conversation. IB plus BBTV Go is your function. This is Bloomberg.
My bottom line message is that I believe more cuts will be appropriate. If the outlook evolves as I have described here, I will support continuing to cut our policy rate in 2025. The pace of those cuts will depend on how much progress we make on inflation, while keeping the labor market from weakening.
Chris Waller, the Fed's Chris Waller, talking about how he sees policy evolving from here. Cuts are coming, but when and what happens with inflation probably will determine the timing. Let's talk about all of this. US bond markets have a shortened day today. Let's get the details on how that session is going to look as we work our way towards it. Valerie Teitel is here with more.
Guy, it's a short session for the U.S. Treasury market, but thankfully it is looking like a stable one. It's looking like the bond route, when it comes to the Treasury market, at least, has calmed down for now. It was a combination of those things we heard from Waller, plus there was no real hawkish surprises in those minutes. But I do want to talk about something that Waller spoke about yesterday, which was his view of the impact of tariffs. He said in this speech yesterday that he does not expect tariffs to have a significant inflationary impact. He also said that tariffs are unlikely to impact his monetary policy view. Tariffs are unlikely to impact his view on growth and inflation. That did calm the Treasury market down a little bit yesterday, but was not calmed down yesterday was what's going on in the UK with the UK bond route. We saw gilt yields spiking yet again, and it is very concerning to see this morning. We're also seeing the pound to the downside, nearly losing over 0.5% so far in this morning's trade. There was a flurry of options yesterday, put options bought for downside protection, which shows that there is some fast money, some hedge funds out there thinking that this move in cable, this move to the downside in sterling, does have legs to go. We have heard some sources telling us that Rachel Reeves is looking at austerity measures, pulling back on government spending instead of tax hikes. The issue is we're just not sure that's enough to reassure markets for now.
Certainly not for now. Certainly that's the early indications coming through this morning. Val, thank you very much indeed. Not exactly a great combination, isn't it? The gilt market doing what it's doing and the pound falling at the same time. That doesn't paint a particularly positive picture or outlook for the UK. Eva Sun-Wai, who manages M&G's global government bond and sustainable macro flexible credit funds, joining us around the table to talk about it this morning. We seem to have moved really quickly on the outlook for the UK. Almost a kind of 180 that's happening here. You got the pound down, and you've got gilts doing what they're doing right now. Gilts down, yields higher. Why has this moved so quickly, do you think?
I think the fact that the pound has moved in correlation with yields, I think, firstly, the appeal of sterling carry has reduced as we've finally started to see weaker data coming out of the UK. And that is, I think, the turning point, because up until now, sterling has followed rate differentials pretty closely. Yep. And we've also seen a pretty strong correlation between gilts and between US Treasuries, when actually the backdrop of the UK looks much more similar to Europe, for example. So I think something needed to begin shifting. I do think the fiscal outlook is looking worrying in the UK. We know that whilst inflation stays sticky, that creates problems for them, because if they do embark on those austerity measures, then we're looking at the stagflation narrative, which I think is the buzzword that has really triggered this move lower on both sides.
What does the gilt market want to see? What's the gilt market asking for?
I think the gilt market would welcome a more austerity type outlook, purely because that points to the fiscal prudence that is currently lacking in gilt markets. But I think the front end will continue to struggle if they do come out with austerity, and whether that comes from lower spending or higher taxes. If that is still combined with that stickier inflation narrative, then that makes the Bank of England's job much harder, and it means that Reeves doesn't have that support from a potential rate cut coming forward, and that brings the front end, I think, with that would likely be a flattening picture as opposed to a steepener.
So you kind of hinted at this. This is a similar dynamic to what you're seeing in Europe as well. And we've been covering it quite ostensibly. What is the difference, though? You're talking about fiscal issues here. We're talking about fiscal issues in France, certainly in potentially Germany as well down the line. What is the game changer, and who has it worse? How are you thinking about it?
I think when you compare with Europe, it's hard to compare with Europe, for one, because there are obviously so many different parts that make up the European area, and how the central bank has to navigate, obviously, all of those different regions. I think, yes, there are, especially at the beginning of the year, the fiscal picture tends to look quite stressed on both sides, because you have a lot of issuance at the beginning of the year. I think the economic backdrop in Europe has arguably been worse up until now. I think we're only just starting to see UK data weaken, whereas I think it seems pretty likely to me that in Europe the ECB will need to be probably the most aggressive in their cutting cycle to prop up the economy.
So how do you trade those spreads then? What's the trade?
I think fiscal differentiation will matter going forward. You know, up until now, yields have looked pretty similar across the board, up until the volatility we saw in France towards the back end of last year. And I think going forward, if you look at some of the regions like Norway, we're then seeing slightly lower debt to GDP ratios. We're seeing slightly better outlooks from the kind of fiscal picture. And I think those names could potentially outperform going forward. I think we also need to watch peripheries, because periphery spreads often follow corporate credit spreads. And we haven't really seen that play out yet. And we haven't seen much weakness in corporate credit spreads. And we've seen significant strength from periphery European spreads, especially because in areas like Italy, there's a lot of technical support as well from retail buyers, for example. So I think some of those trends could start to unwind this year, and those would look like more potential entry points, I think, depending on what happens as well with corporate credit markets.
Comparisons are being drawn, warnings are being issued that this is already or heading towards being a Liz Truss moment in not just the UK but the US as well. Is that hyperbolic either?
I think markets are still recovering from what happened in 2022, and I think there is a lot of stress that we will look like that again. I don't think we're coming out with an unfunded tax cut type budget, so actually the fundamental picture from the UK is going to look very different in terms of what is driving those yields higher. In the US, I think it all depends on not just Trump's policies, but also the sequencing of them and the size of them. You know, some people are saying tariffs won't be inflationary, some are saying they are. And well, there will be a big difference between if the tariffs are 10% or if they are broad brushed. And so I think there's a lot of uncertainty that will hopefully be cleared with sequencing, sizing, timing, etc.
So then if Q4 was like a textbook Trump trade, strong
Yes.
dollar, US stocks outperforming, how long do you see that lasting after the inauguration?
Yeah, I think, again, it will very much depend. I think the Trump trade has been driven by almost what markets assume to be probably not the most extreme, but definitely not a pared-back version of his policies. So they're assuming pretty aggressive tariffs, they're assuming deregulation, we're assuming policies that focus on immigration, etc. And I think what will matter is how they implement these bills. For one, there's talk about whether they do it in multiple small bills, whether they do it in one big bill, and how that would then pass through Congress. They have a majority, but remember, it is also a slim majority, and a lot of Democrats oppose, for example, a lot of the policies when it comes to tariffs and immigration. So they do need to, in order for these things to be executed quickly, they do need the support of course, probably a lot of Democrats as well. And so going forward, I think hopefully we'll get a lot more clarity in the next couple of weeks when we understand his priorities, and I think appointments to the cabinet will also be really important in that.
Certainly something we're going to be keeping a very, very close eye on. We're already seeing, of course, some pretty substantial weakness in cable this morning. 122.89. They look down my screen. Ava Sun-Wai walking us through the UK story this morning. Fund manager over at M&G Investments. We thank you so much. Coming up, we continue the conversation with the UK. The UK Chancellor comes under growing scrutiny, as we just discussed. Rising gilt yields, all but wiping out her fiscal headroom. We're going to dive into the details of what options she actually has to maybe reassure the markets a little bit, outline some of the needs around that fiscal headroom, and what those risks may actually look like. That conversation next. This is Bloomberg. Thirty minutes from the start of the opening trade. When you look at the futures picture, you are going to see a little bit of a translation over from the States as well. Red on the screen there, your Stocks 50 futures down about 0.2%. The CAC 40, really the underperformer here, down about 0.4%. Even over in the States, already you are seeing a little bit of a doom and gloom picture. When you look at the bond market, though, we do have our eye on the UK bond market. That's going to be opening in about 30 minutes time or so. But for now, marginal moves to the upside in those yields. German 10-year, again, flat at the moment. Marginal moves from the France and Italian 10-year as well. But I think really all eyes on what happens to gilts in about 30 minutes' time.
29 minutes until the gilts open. I think we're all on tenterhooks. We've already seen a move lower in the pound. it's the mix between the pound falling and bonds falling, i.e. yields going higher in the UK, that feels really toxic at the moment. And that's where maybe the difference and the fear really stands out in what is happening here. We asked the question just a moment ago, what does the gilt market want, Lizzy? And I think that's the key question here. What does the gilt market want Rachel Reeves, Keir Starmer to deliver at this point? Is it an austerity budget? Is it more tax hikes? I don't know. What does it take to get everybody back on board?
Well, I was about to say, Eva was signalling that the gilt market might like austerity. That ain't going to be politically popular, is it? And if she went for more tax hikes, that is not going to go down well with business either. The plan was for Rachel Reeves to head off to China this weekend and then on her return make this speech about how she's got an ironclad commitment to the fiscal rules and she's pro-business and pro-growth. Yeah. But at this point, that's a kind of long-term thing.
You wonder by Monday whether the fiscal rules will have been broken.
Well, quite. And, you know, all eyes then on March and what the OBR's growth read is and whether she actually has any headroom and whether she needs to make this choice between spending cuts and tax rises.
But where did those spending cuts actually come from? If you look into the nitty-gritty, what pieces are even have the room to be cut?
Exactly. I mean, are efficiency savings, quote unquote, going to cut it at this point? Everything is squeezed, and as you talked about, as Eva talked about, the more you squeeze things, the less growth you get, and then you start talking about stagflation.
Doge. We need Doge. we need efficiency to be delivered within the public sector.
Yeah, perhaps. But let me also say, we've had this report from the Recruitment and Employment Confederation, the REC and KPMG, on the jobs market that perhaps might be missed usually, but in the dismal state of UK labour market data of late, this is really important for the Bank of England because you've got vacancies falling. They have been falling, but this is a sudden drop. And it's not because they're being filled, it's because jobs are being taken off the table, which is worrying for Rachel Reeves again.
But that's a response to the National Insurance contribution story, isn't it?
So she caused it. Perhaps, because she's put costs up for business, and then it's going to come back to bite her if growth shrinks and she doesn't have the headroom that she needs to pay for all her plans, and then she has to turn to spending cuts. Look, it's an extremely difficult situation here. Kriti, you asked how is Rachel Reeves going to make these choices. Fortunately, we've got an expert in all these things. Carl Emmerson, Deputy Director of the UK's Institute for Fiscal Studies, joins us now. Carl, good morning. Thank you so much for joining us. I just want to start with the headroom question that Rachel Reeves left herself a wafer thin margin after the budget. I spoke to her after the budget and asked her about this because it seemed like we'd end up in a situation like this. Was it irresponsible to do that in her first fiscal event?
Well, I think you're certainly right to say it was wafer thin. 10 billion of headroom sounds like a huge number, but in terms of size of the UK economy, the forecast for tax revenues, for spending 5 years out, it's really, really tiny. So we shouldn't be surprised to see a revision to the forecasts of much more than £10 billion. Now, of course, that could have gone in the Chancellor's favour, but equally with an independent forecast that's a central estimate, it's just as likely that it goes against the Chancellor. So not really a surprise. Was it irresponsible? I think it's more about how difficult the trade-offs are at the moment. She put taxes up a lot in her budget. She increased spending by quite a lot this year and next, but the spending plans beyond that already looked pretty tight. So that trade-off by should she have taxed more? Should she have announced even tighter medium-term spending plans? Or should she have been trying to borrow more money? That's very, very difficult. And it comes back to the problem the UK has, which is a high level of debt, which is no longer very cheap to finance like it was in the 2010s, and a really weak outlook for economic growth. And that combination is going to be difficult for whoever is Chancellor.
So if push comes to shove and she actually doesn't have any headroom left, and as she indicated to us, she has to choose spending cuts over more tax rises, is that a wise choice economically? We've heard about the gilt market perspective, but, is there room for these cuts, or would she be flirting with austerity again?
Well, I think in terms of the economics of it, it doesn't really matter. It's not really any different if government revenues are going to be £10 billion more than spending in 5 years' time, or £10 billion less than spending in 5 years' time. It's all a rounding error. Where it might matter is it's very important the Chancellor, having set out some fiscal targets, having said that she's going to take the public finances seriously, which is very important, that she doesn't erode that credibility. I think that's the strongest argument for taking the rule very, very seriously, as opposed to it fundamentally mattering. What
Does
she
she still
will
have
do,
credibility?
I guess, well, I think to preserve that credibility, what she probably might do is to say, yes, there may be some modest tax rises. Maybe those spending plans will be trimmed back at the later end of the Parliament. But of course, then there's question marks about whether she's serious about delivering those spending plans. It's one thing to pencil in tight spending plans for year 4 and 5 of your forecast. It's another one to be serious about delivering it.
Carl, to what extent does Reeves's fate hang on what the Governor of the Bank of England does on the 6th of February? How important is the bank's outlook then going to be in determining the path here?
Well, it's really about all of the borrowing costs. UK government debt isn't just about gilt prices. A large part of it is actually financed at bank rate because of the way quantitative easing works and the gilts that the Bank of England have bought. So if bank rate doesn't follow the path that the latest forecast from the Treasury expected, if it turns out to be higher than that, that will add yet more to that debt interest bill that the Chancellor is facing. So, you know, a lower bank rate would certainly help. Less quick cuts in bank rate would make things slightly more difficult for her.
Should the Bank of England stop QT?
I think that's a very difficult one. Clearly, the Bank of England is independent. It's trying to hit a 2% inflation target. I think it'd be very difficult for the Chancellor to say, well, actually, it's not very helpful for you at the moment to be trying to sell all these gilts back onto the market when the UK government is trying to borrow so much more. But that's also another reason why this is so much more difficult than the 2010s. We had a lot of government debt in that period, but it was just very cheap to finance. The Bank of England bought a lot of it, was financing at an ultra-low bank rate. Gilt rates were low. That's just another example of why it's difficult at the moment. Not only are interest rates higher, but it's not just the government trying to borrow money from the private sector. It's the Bank of England selling those gilts back. So it makes the challenge harder for the Chancellor. But I don't think I'd suggest that the Chancellor should get involved and try and tell the Bank of England what they should be doing.
Carl, there's still a narrative from the international audience that in a world of geopolitical volatility, the UK still remains, despite some of their fiscal issues, an island of stability and therefore an attractive investment case. You've seen that argument made in the stock market, the bond market, arguably the currency market, although perhaps not so much this morning. Is that a reason for the UK government to actually issue more, to take advantage of that?
Well, that's exactly what happened back in October. The government, while increasing taxes by a lot this year and next, they increased spending by more than that, partly for day-to-day spending on areas like the NHS, partly because of a big increase in capital spending. In terms of, you know, the UK's strengths at the moment, I guess having a big majority, a government that should be able to look to the longer term, enables it to now perhaps focus on making sure that those investments are done well. And I noticed earlier in your discussion, you were saying, well, what do the gilt markets want? Well, you know, a credible strategy delivered well. It's difficult when actually the equivalent of gilt rates are rising elsewhere in the world. But perhaps one of the most important things the government can do now is make sure that investment spending that it's set out is going to be spent, make sure it's spent and make sure it's spent well, because that's the kind of thing that can help to contribute to stronger growth.
Is there a currency impact to all of this? I mean, when you look at some of your peers in Europe or even in the States, the dollar, the euro are closely watched. How does the weakness in the pound factor into this?
Well, I think, again, it's a factor that doesn't help. It's not good for the UK economy when the pound is so weak. It's important to remember, though, if we get a bit more inflation in the UK, there could be a little bit of a silver lining for the Chancellor in that faster inflation, if that's associated with these interest rate rises, it might make them slightly less painful because a bigger cash economy will help on the tax side too. So, for example, your VAT revenues may be boosted a bit to help offset some of those debt interest costs.
If you were advising the Chancellor today, Carl, what would you say she should do to handle this in the short term? Can she really afford to wait for a press conference in China? Can she really afford to wait for a speech on her return where she kind of tries to appeal to business and talk about how she wants growth and talk about her commitment to fiscal stability? Or does she need to take action again today?
I don't think she needs to do that. I think the most important thing is to when the opportunity arises, to continue to say, look, we take UK institutions seriously. The independence of the Bank of England, for example, the OBR will be producing our forecasts. We take our fiscal targets seriously. There is much to commend a target that says we will remain on course to roughly ensure revenues are enough to cover day-to-day spending. So just reiterate a commitment to that. Then when we get to late March and we get the forecast, the Chancellor has a big decision to make about whether, if the forecasts do suggest she's on course to miss her target, and remember, they might not, that 10 billion of wiggle room might not be entirely exhausted. Does she take a little bit of action in the March budget? It might only require a modest adjustment at that point. Or does she leave things until the autumn budget, where she said she only wants to have one fiscal event a year, which again has got much to commend it. We don't think we should be changing tax and spending policy too frequently.
Carl, can you put your finger on a catalyst for what is happening right now? Is there something that's happened over the last few days that I've missed that has created this situation? There is obviously one narrative that suggests that we're just simply importing higher back-end yields out of the United States, and that is what the UK is suffering from here. To what extent is that true, and is there something else that I'm missing?
Well, if it's certainly true that if UK borrowing costs are up quite a bit since the budget, but they're not up by much more than, for example, the average of US and German borrowing costs. US ones have gone up by more, German ones by less. So we're not that much of an outlier here. So I think the story that this is something that's happening elsewhere too is pretty credible. But again, then when you ask the question, well, what can Rachel Reeves do about it? Well, it's also pretty hard to see the answer, because fundamentally, if it's because the US is expected to be borrowing a lot more money over the next few years, that's not something that's in her toolkit to try and fix. But I think I've got a lot of sympathy with the story that says, well, actually, these things are just coming as external shocks. The UK is going to have to deal with them. It doesn't make it any easier for it doesn't really make it fundamentally any easier for what the Chancellor does if it does give her less fiscal headroom.
So as Kriti says, it's a combination of the dog wagging its tail and the tail wagging the dog. Carl Emmerson, Deputy Director of the UK's Institute for Fiscal Studies, we thank you as we get towards the opening of the gilt market. But coming up on the programme, US dockworkers reach a tentative agreement with their employers to avoid another strike at the ports. So we're going to check in on the reaction from European shippers and your other stocks to watch next. Do stay with us. This is Bloomberg.
$12 minutes to the equity market open here in Europe. More critically, 12 minutes until the gilts start trading in London. Ven Rahm, Bloomberg M-Live cross-asset strategist, joining us now to discuss. Ven, comparisons are being made to Liz Truss, but is this more Callaghan than Truss? Is this more 76 than 22?
Possibly. What we are seeing in the UK, Guy, is a train wreck in slow motion. The markets have gone into a tizzy, wondering whether, Treasury 10-year yields are going to get to 5%. But what they need to watch is the storm in the UK markets, where 10-year gilt yields are likely to get there first. So what is worrying is that the pound is getting hammered as well. So this is about the markets passing a no-confidence motion against the UK every single day. The options before Chancellor Rachel Reeves are pretty strong. Either she's got to curtail spending or she's got to put up taxes. Reeves is keen to spur economic growth, so she may be averse to curbing spending, but I think something's got to give here. Raising taxes will crimp consumer demand and consumer spending, so it'll send the economy into a tailspin. So both options seem unpalatable. What all this means for the UK is that traders are going to be selling first and asking questions later. Thing is, Guy, with the genie out of the bottle now, something's got to give. And the big question is, what will that something be? As the government figures out what that something is, gilt yields rate differential versus treasuries will widen while the pound will get pummeled in the weeks to come. Whether this is going to be a revisit of the 2022 moment, Liz Truss moment, or 1976 remains to be seen. But I would say that 1976, when the UK had to borrow from the IMF, is a distant prospect at this point, especially because Reeves has got a budget update coming up in March where she will no doubt listen to what the markets have to say.
Ven, before you depress me too much, let me put the gilt story on ice for just a minute. There is a bright spot when it comes to gold. 2664 is where we trade at the moment. Do you see it getting to $3,000 maybe?
Possibly, but well, I'll tell you something, Lizzy. I'm not so upbeat on gold as I was last year. I'll admit that. Gold has taken its inspiration from the Fed's rates trajectory since the rally began. But in a situation where the Fed is going to go slow on rate cuts, gold's upside will be blunted. My model shows that the gold will reach $3,000 an ounce. But for that to happen, the Fed's benchmark rate needs to go down to at least 375. So we are essentially talking about 3 more rate cuts from here. From current indications, it doesn't appear that the Fed is in a hurry to get there. So gold will essentially be treading water until there is a turn in the US economy that is sufficient enough to spur the Fed back into rate cuts. Mind you, real yields in the US are climbing higher, which is also negative for gold, but gold is clinging on there to current levels, which shows its resilience, and the markets hope that it will eventually get the upside of possibly 3,000.
Well, 2665 on the precious metal at the moment. Bloomberg's Van Rom, we thank you so much. You get more up-to-date analysis from him and the team. MLIV is the function on your terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton.
Kriti, so we've got lots of UK retail sales updates today, including from Tesco, which says it's had its biggest ever Christmas and its like-for-like sales smashing at the top end of their forecast, according to analysts. And that stock's had a decent run over the past year, up around 23% on a one-year basis. But the other stocks to watch in the retail space today are Marks & Spencer's, Greggs and B&M. Now, Marks & Spencer's once again doing really well in food, not so strong on clothing and home, and the one that is looking more negative out of the three is B&M. This one is called lower following some weak profit. Once again, that did have a rough year and dropped out of the main FTSE index. Now, this plays into what Van Ram was discussing a few moments ago, because retail has had a really rough run over the past couple of weeks, including this FTSE retail index has dropped quite a lot on a 3-month basis. Those losses have accelerated this week, of course. Then in terms of the other sector we're going to be watching today, this is shipping. Now, there is reports that dockers in the US are potentially nearing a deal with workers and unions between the companies and themselves. That could potentially be coming through in the next few weeks. It's only a tentative agreement at the moment, but that is actually seen as potentially negative for shipping rates, because disruption, of course, means rates go higher. So we're watching Maersk, Hapag-Lloyd, Canaan, all of the usual suspects for that one. Keep an eye, though, on the Shanghai futures in terms of the container rates, a closely followed index, down around 11% on a 5-day basis for that now. Then in the pharma space, GlaxoSmithKline doing a $1 billion M&A deal. This is for an oncology company that is privately held over in the US, but it's a decent punchy amount. We can see GSK does need a bit of a boost, underperformed recently. Then in terms of analyst ratings, once again a busy day. Shell goes up to buy at UBS, while Volvo is an overweight at Morgan Stanley. And on the negative side, Swatch in the watch space cut to underperform at RBC. Expect that one to be a little bit weaker over in Switzerland this morning.
All right, Joe Easton, our equities reporter, we thank you so much walking us through some of the stocks that may move ahead of the opening trade. We're about 7 minutes away. In the meantime, let's bring our attention to what's going on the west coast of the United States. We are seeing live pictures in just a moment. There they are of Los Angeles, Studio City at the moment, as you see the wildfires getting closer and closer to the city center, Hollywood Hills. I mean, these images are like from a movie, truly. And, of course, endangering hundreds and thousands of lives, evacuations across the city.
A human crisis, a financial crisis. The insured losses here are going to be significant. And it raises the further question as to whether or not key areas of the United States are now insurable, how they're going to be insurable, what the regulatory surrounding, the picture surrounding that insurance is going to look like. So many questions, I think, on the back of all of this. And how human behaviour maybe needs to change as well. Are these places habitable still?
Yeah, do you get migration within the US, like we talk about globally, but away from that coast? If you can't
people were moving to
living.
Florida, not away from Florida. Or I thought people were moving, like maybe California is a different case, but that doesn't seem to be the narrative at the moment.
It certainly changes it. Let's bring it back to the economic story, though. You mentioned the kind of the effect on insurance. There's also an economic effect here. California contributes about 14 to 15% of national GDP to the United States. When you've seen wildfires like this, notably in 2018 and in 2020, it's taken up to 1% of national GDP. So this is something that's going to show up in the economic data as well, in addition, of course, to the human and the insurance cost as well.
So in a few minutes' time, we're also going to see the Gilts opening. That is going to be a story that we're going to be watching very, very carefully. European equities are about to open. Remember, the US is closed today for Jimmy Carter's funeral. That will obviously take some volume out of the market. This is what the futures picture looks like right now as we head towards the open in 5 minutes' time. This is Bloomberg. Thursday morning, good morning. I'm not entirely sure how useful this chart is in terms of an indication as to how European equities are going to trade today. Remember, the US is out today. The back end of the session yesterday did see a little bit of a pickup in terms of US stock prices, but not by much. But what I'm looking at the moment is futures that are a little bit softer. And I also think there are other factors in the mix this morning. What is happening with the pound is going to have a big impact here in Europe this morning. What is happening more broadly around the bond markets will probably have a big impact as well. Lizzie, what are you seeing in futures?
So Eurostoxx 50 futures are pointing lower by 0.4%, down even more for CAC 40 futures, down 0.6%. It looks like optimism when it comes to FTSE 100 futures, but it's really the FTSE 250 you want to be watching at the open, given the domestic focus. And I would say mind the house builders, because BOE bets have been paired in the past half hour while we've been on, shaved now to 42 basis points of cuts in 2025. So I'll be watching the house builders at the open. But Kriti, what are you watching in terms of sectors?
Well, still certainly going to be a big focus on the UK, as you mentioned. We also had some numbers coming out of Tesco this morning. So some of the supermarket kind of stocks as well are going to be very much in focus. Tesco in particular, saying they reached the UK market share the highest since 2016. Those food sales beating their estimates. They're also going to keep an eye on GSK as well. Looks like they're on nearing, I should say, a $1 billion deal for a U.S. biotech company that's developing a drug for a rare tumor. Another part of that kind of M&A bolt-on acquisition story in the healthcare space. And then, of course, shippers, as we do have a deal now agreed upon between the U.S. dockworkers at some of the ports in the States. That was an overhang guy. Maybe today we see some positive reaction in the shippers.
We'll see what happens there. It's going to be interesting to see how the FTSE 100 trades this morning. Pound down, FTSE 100 generally rises. Right, it's time for the opening trade. Let's take a look at some numbers, get an idea of what is ultimately happening. It will appear on the screen in front of you. I can hopefully assure you of that. It's not working. But I can tell you that maybe we are going to be seeing a different story when it comes to the FTSE 100 and what is happening with the rest of the European space. We're going to wait for Gilts to open as well. That's going to be a critical story too. I don't have the numbers. Kriti does. Let's hand you back to her.
Well, we are, of course, seeing, as expected, that we are going to see some outperformance in the UK, and that's exactly what we see. We are seeing a pretty decent boost this morning from the UK. Excuse me. Oh, just paired back in literally the seconds I'm talking, which I think really indicates the kind of volatility we're dealing with. What you do need to know when it comes to Europe is that it is underperformance across the board. So the CAC 40 is the underperformer. They're down about 0.4%, and a lot of the kind of downside move is coming from what I can see as well, just across the board. It's not necessarily in one particular sector. It seems like a risk-off day, Lizzie, when it comes to the UK and, when it comes to the European stock market. Yeah, just checking in on the gilt story as it opens. The 2-year gilt yield higher 9 basis points at 4.6%. The 10-year higher 9 basis points at 4.88%. The 30-year higher 9 basis points at 5.4% this morning. These are shocking moves. Checking on the pound, lower 0.8% at $1.22. The FTSE 100 flat to the upside, but the 250 down 0.2% currently. I said that we should mind the house builders.
builders. You've got Persimmon down 2%, Barclay down 3.2%. You've seen, as I say, the Bank of England bets being paired while we've been on air, so less cutting expected from the Bank of England, but that reaction from the house builders. What else are you watching, guys?
That's stagflation, isn't it? On the screen in front of us right here. So you've got basically a slowing growth picture. The house builders are signalling that in so many ways. You've got a pound that's under pressure. That's the growth narrative that's being taken out of the market. The inflationary narrative, the Bank of England story is being priced into the Gilts narrative as well. It's all there, written across the screen in terms of how the market is perceiving all of these risks right now. As you say, you've got a series of UK companies that are falling this morning. Bellway, in terms of the points, it's Bellway, Drax, Just Group, Vistry, Burberry, Johnson Matthey, Investec. It's a reasonably mixed-up group in terms of the narrative. It's interesting that some of the more international companies are faring a little bit better. So stocks like Carnival are doing a little bit better this morning in terms of where the rotation is taking us. But this is an ugly picture that is being presented on our screens first thing this morning for the FTSE 100. People are hiding out in the safety of stocks like Unilever. Anything with a domestic focus is seeing some weakness.
You are also seeing, and you mentioned the currency picture as well, you are seeing weakness in the pound, which is giving a boost to the euro relative to the pound as well. So that is, if you are looking for a bright spot in Europe, I think I just found it. And again, as we are looking at kind of the broader stock picture, FTSE 100 is outperforming, but not by a massive margin. The only, I'm just going to call it flat, marginally green, but flat story on the UK. We'll see how that develops throughout the day. Let's bring in an expert on all of this. Bilal Hafiz joins the program, CEO and head research over at Macro Hive. So we've been debating on the program in the last hour or so how so many of these kind of almost threads that we're seeing in the UK are truly global issues when it comes to fiscal headroom, when it comes to the deficit, when it comes to spending cuts, et cetera. You're seeing it in France, you're seeing it in the US. How do you trade it relative to these other countries?
Well, I think you're absolutely right. There's a global story, I think, that's going on, number one. And I think 2025 will be about how all of these cross-currents intersect with each other. The biggest one, I think, is that we are still in a relatively high inflation regime. That inflation hasn't been defeated. So that means all the central banks that started to cut rates last year are going to have to pivot one way or the other. And for the UK, that's a particular problem because the Bank of England has constantly tried to be dovish, even though the inflation picture has been sticky. The other issue is the debt levels and deficit levels that we're seeing across the world. The UK has a problem where it also runs a current account deficit, which means that it relies on foreign inflows. And so it requires more credibility than, say, Europe, which has a surplus, current account surplus. And so the UK then has this challenge of trying to attract the capital inflows to sustain its gilt market. So I think the UK is in a particularly difficult problem. I think it has all the problems of all the macro risks that we have this year. And so as a result, I think this is why we're seeing what we're seeing at the moment in the gilt market.
So steepeners have been kind of the trade du jour for a lot of the bond markets in the last couple of months. I would argue in the last year or so, specifically since the third quarter of 2023. If everyone's putting on that trade, do you still put it on?
I think you do, and you may not even need to put steepeners on. You could just do outright short 10-year yields. I think what's interesting is that even though central banks have been cutting rates and the front end has been, yields have gone down, what we're also seeing is an increase in term premia. So it's not only a revision of expectations of monetary policy, that there'll be less cuts, there's also an increase in term premia back into the curve, which to some extent reflects the fact that we have these debt issues.
Yeah.
And I think that's going to be a more important driver this year.
Does this, what we're seeing unfold at the moment, does it in any way change the narrative that you just put money into the States? That's the safest place to put money right now.
It does in some ways. I think what this does is it tells you that the bond sell-offs that we've been seeing, whether it's in the US, the UK, Europe, everywhere, may well continue. So all the talk about, US 5-year, 10-year yields are attractive to go invest in, that could be a risk. You
see more upside.
There's more upside even in the US
yields, right.
in the yields, because the Fed may not necessarily cut as much as people think this year. Inflation in the US may actually end up being higher than people think. And so as a result, then term premium comes back into the curve.
Yep.
So even US yields could end up higher.
What I'm really asking is this narrative that's driven markets for the last few years, American exceptionalism, America's economy is doing better, America, therefore, is the place to park your money. It's sucked in huge amounts of foreign flows. Presumably what I'm seeing here in the UK this morning just encourages me to continue to do that.
Absolutely. From a growth perspective, that's certainly true. The US, is seeing higher productivity than other parts of the world. The growth numbers are generally stronger as well. So in that sense, it's true the US is a more robust place to invest. The problem with the US is valuations are stretched.
Yep.
So, PE ratios in US equities are already pricing in that exceptionalism. And so the challenge for the US will be, what happens if US yields rise further? Can those valuations remain so high?
Bilal, you've put together your annual list of grey swans for 2025, things that are possible but improbable. I had to chuckle at some of them. We'll leave Man City aside. But you have said that on item 5, Keir Starmer could return to the polls. I wonder, is the most likely reason that that happens because the economy has gone down the plug hole?
Absolutely. I mean, this comes off the back of the plunge in popularity of Keir Starmer, and we were trying to think about what circumstances could you have which could lead to a Labour majority somehow collapsing to trigger an election. One would be geopolitics in some way, whether the UK gets embroiled in some Middle East war and that splits the Labour Party, and so that could be something. The other could be a fiscal issue like we're seeing right now, whereby, because of this bond route, maybe tough decisions need to be made around cutting spending on the NHS, and that splits the Labour Party, and then you have this vote of no confidence. And then that somehow sort of triggers an election. So that's the possible scenarios that we could see. Of course, it's not a base case. It's very unusual for a party with such a large majority to collapse in that way for a general election.
Yeah, I mean, it was similarly unimaginable when Boris Johnson got his landslide majority, and look how that ended. The other one on your list is that we get a return to zero interest rates, so bringing it back to the Bank of England. Could the Bank of England genuinely be the only saviour that Reeves can rely on?
I think there's some truth in that, insofar as the Bank of England could be the only saviour for the gilt market, insofar as the one thing they could do is to stop doing QT, and so return to becoming a big buyer of gilts, and so that would just stabilise gilt markets and auctions and so on. The other could be, if they were to cut rates significantly, that would reduce the interest rate costs in the fiscal numbers. So the problem in the UK, you have this death loop now in terms of the fiscal rules, whereas gilt yields or base rate yields go up, then the spending buffer, according to the fiscal rule, disappears, and so you have this vicious spiral. So the Bank of England could save the UK in that respect. The question then is whether they now get captured by the fiscal authorities and they lose credibility then.
Does that credibility factor get priced into the market, or is that what this is?
I think at this stage, I think there's some inklings of a credibility issue, but I don't think it's as extreme as we had under Liz Truss, where there was a very precise effect where, Liz Truss got elected, announced a budget, and then gilt yields exploded higher. This time we're not seeing that. The gilt yield move, while it has been quite large over the last few days, it comes in the context of yields going up quite significantly. So we're at the stage now where there's a risk that credibility comes under fire, and this is the big test now for the next few weeks, whether this becomes a credibility issue, whether it's on the Bank of England side in terms of inflation credibility, or whether it's on the government side in terms of fiscal credibility.
It's January the 9th, OK? We're 9 days into this year, and we're seeing a series of crises emerging around the world. The UK, obviously, the epicentre of the story this morning, but who knows what's going to happen on the 20th when Donald Trump assumes the presidency. How easy is it to predict this year? What kind of volatility should I be expecting? How dangerous is it going to be this year to invest? How difficult is it going to be to invest this year?
I think it's going to be very, very challenging this year. I think for a number of different reasons. One is that inflation hasn't been completely slain, which makes it difficult for central banks to cut rates and bail out markets. Equity valuations are stretched in all the places that you want to invest in. And then government deficits are very large during peacetime. And so all of these factors are coming in just to lead to a more fragile market environment. Then you get all this political volatility in terms of Trump announcements and such that we're going to have over the course of this year. So I think it's going to be a very, very challenging year.
Everybody's
stunned you into silence.
No. I think it's going to be a challenging year. Lack of communication. In terms of how this is likely, what is your base case right now? And how challenged do you think that base case? How quickly do you think any base case is going to be challenged?
It's a good question. Our base case in general are higher yields across the world, and that's sort of occurring right now. The risk for us is that it all happens in January, and we see this move up in yields everywhere in January, and then nothing happens for the rest of the year. But our base case is higher yields across the world. Behind that is the fact that central banks won't be able to cut as much as what's priced, because inflation's more sticky. The other thing we're looking at also is equity valuations do look stretched in the US, so they will start to get challenged by these higher yields. So this year will be the crunch year for equities.
If equities come down, where do you hide? And do you hide in Europe? Do you hide where is the diversifier this year? Where is the uncorrelated asset this year?
I think it's hard to find anything uncorrelated. Everything's correlated in this current environment. Where you do see some value are places like Eurozone, China, maybe Japan to some extent, but they all have their problems. So the real non-consensus trade for this year would be some kind of bullish China growth story. So that would be the thing to perhaps play for, because people just aren't invested in China because they're worried about tariffs, the economy's doing terribly, inflation numbers have been incredibly low.
Yep.
So that would probably be the one area where we could end up with a big surprise.
Well, you can certainly see it in the inflation numbers this morning. China 0.1 on its CPI print. The rest of the world dealing with an inflation narrative that doesn't seem to want to go away. Bilal, great to see you. Thanks for stopping by to see us. Bilal Hafiz, the CEO of Macro Hive. Core 6 looks like this morning. This is the narrative we're looking at. You've got generally red across the screen. Novo Nordisk bouncing a little bit, but not by much. Elsewhere, you are seeing weakness. Schneider absolutely flat. There are significant effects flowing through from what we're seeing in the UK into UK stocks. What else are we watching? Let's find out with Joe Easton.
So we are seeing some big moves in the UK, Guy, particularly in the retail stocks. Some of these are catching people by surprise at the moment. Marks & Spencer's down 6%, was down around 8% at the open. I asked some traders about that, and one of them said nobody knows why it is down so much, though the outlook commentary was slightly negative, but it pretty much looked almost in line on the statement, so we'll have to dig into that one a bit further. Very surprising move. M&S now down 6% at the moment. Then we've got Tesco, again, coming down, possibly some of this related to the stuff that we've been talking about on the show, about the broader UK theme, so that is potentially weighing on the stock. So we can see even Greggs down another 8%, a very steady stock, selling all those sausage rolls, of course, and B&M Europe, that one just continuing a very bad run for the discounters at the moment. UK retail really, really weak today. Very interesting moves on that one. Then in terms of shipping stocks, big moves there as well. We've got AP Moller Maersk down 6%, Hapag down 7.2%. Now US Dockworkers reaching a tentative deal with companies in the US, and that would potentially weigh on shipping rates, weigh on the profits. So that one a little bit easier to explain, although slightly complicated in terms of the reasoning on that, but definitely a weak part of the market due to that news on shipping. Then, in terms of a bit of a share sale, the Italian gambling company Lottomatica announced a big share sale last night, so they're selling stock at a discount. That one's a recent IPO'd around a year ago for that one, but we're coming down 2%. Investors getting out of that one this morning, so we've got some weakness there. Then, looking at home builders, once again, it has been a feature on the show, and we are seeing Berkeley Group declining today. That was down at 3% at the opener trading, now 1.9%. Barclay, two ways to pronounce it. I think my second one was correct. But that one is also reinstated underperform at Bank of America. They've got a big note out. They're not citing rates as such. They're citing weaker volumes, but it adds to the worries for that sector at the moment. One stock giving us a bit of green, finally, to end on is Shell. That gets a buy. We're at UBS for that one. We've had a couple of buy ratings on Shell. They are citing the cash outlook, the cash flow outlook, very strong in terms of potential capital returns. So they go up to buy on Shell, and that stock is gaining 1%, recovering from some of the declines after yesterday's trading update here in London.
All right, thanks for the silver lining. Joe Easton from our equities team. As you say, broadly, the mood has soured in the UK. The FTSE 250 down 0.7%. It had been down more than 1.1% in early trading. Looking at the gilt market, yields soaring again. The 10-year yield up 6 basis points at 4.8%. The 2-year yield up 4 basis points at 4.5%. The 30-year up 5 basis points at 5.4%. The pound's been down against the dollar by 1%, pairing some of those losses now. You're looking at the pound trading at $1.22, now down 0.7%. But this is a bleak morning in the UK. We'll have plenty more ahead. This is Bloomberg. We're 18 minutes into the trade today here in Europe. Welcome back to the opening trade. And it's not looking pretty, at least for the UK, as things stand. The UK Chancellor Rachel Reeves tried to calm things yesterday. She made this rare intervention, a Treasury statement reaffirming her commitment to fiscal prudence, but it doesn't seem to be working. Look at those gilt moves at the open. The 2-year yield higher 3 basis points at 4.5%. The 10-year up 5 basis points at 4.8%. The 30-year up 4 basis points at 5.3%. Let's talk about why this is happening with Anna Andrade. She joins us from Bloomberg Economics. Anna, we've been debating how much do you attribute this to the domestic picture and how much do you attribute it to the international story?
The movement in Gilts, you mean? Yeah, I think it's interesting because there's been a lot of comparisons with the trust moment, and I think there's, at least in my head, there's at least three reasons why it's not. First one is that question exactly. It is part of a global story. So probably 70% of the guilt movements we've seen have been also seen in the US. The second one is that essentially the scale of the shock, because in trust, during the trust moment or after the mini budget, you saw yields rising by 100 basis points in 4 days. That's a huge thing that we're not seeing right now. It's sort of a more gradual increase. And then there's, of course, the third factor that so far we haven't seen, but I think it's the big unknown. In trust, 50%, there was a work from the Bank of England that said that 50% of the movement in yields was a reaction to fiscal and 50% was attributed to the liquidity crisis in the LDI funds. Now, there's obviously pockets of weakness and fragility in the financial sector. We don't know what this will, trigger, but so far the reaction hasn't sort of spilled over into anything else. So, I think we're not in a trust moment. I think part of it is a global story, and that's also one reason why, the Bank of England and even the government a bit might not feel the need to sort of come out and tackle it just yet.
Well, a sell-off on the long end of the curve, to your point, was before it even hit the gilt market. You were seeing it in the States. You were certainly seeing it in parts of Asia as well. But is there an argument for it, or is this just kind of de-risking ahead of the new year?
I think there hasn't been any sort of game-changing data, if you want, to sort of trigger this, but markets, are not rational. I think there is a general question of where inflation is going to head in the next couple of months. Now, in the UK, we are seeing some sort of bad news in the sort of real side of the economy. We've seen that in today's jobs market report. We're seeing GDP also and activity also weakening, but inflation is not really sort of yet falling as fast as the Bank of England would like. But actually, today's jobs market jobs report that actually show that demand is weakening might actually go against this movement in yields because, as the Bank of England said at its December meeting, and it has been saying this for some meetings now, a period of economic slack might be required to sort of bring inflation back into control. In December, they said that the labour market was probably balanced. So that's now we're now at the point that any further weakness will start off sort of waiting on inflationary pressures.
The bank's made it really clear that it wants to use interest rate policy is its primary mechanism by which it's going to control what's happening with the economy and dealing with the inflation narrative. The QT story is meant to have been on rails. It's kind of something that happens in the background and just carries on. Does that now need to change in as much as we've got a bit of a gilt crisis? Should the bank be still selling into a market that is experiencing this kind of a crisis? Can it logically contain inflation with rates but deal with the gilt crisis by ending QT?
Yeah, I think the fact that it's a global story might take a bit the pressure off from changing any sort of QT parameters. I think one thing that is interesting to say as well is that most of the QT that will happen this year will come through redemptions, the big chunk of it. So the share of active sales is actually pretty small. Okay. And I think going back to the real economy, I think we're seeing this sort of weakening, and the bank, I think, it's confident that if you see sort of weakening in the economy, that will feed through. That's sort of how the dynamics work. So we're just going to have to wait, I guess, a little bit longer into sort of seeing this weakening then translating into prices and into wages.
We'll see what happens. It seems to be accelerating at the moment, certainly. Anna, thank you very much indeed. Anna Andrade joining us from Bloomberg Economics. Let's take a look at what is happening with the stock market effect surrounding all of this. You've got two factors in the market this morning. You've obviously got the broader crisis as to what is going on, but then you've got a series of retailers that have been pushing out numbers first thing this morning, talking about how trading has happened over the Christmas period. Tesco, Marks & Spencer, two of the companies that have been reporting their sales. They've actually broadly been ahead of expectations, though maybe the outlook statements don't look quite so good. Dasha Afanasya joins us now on set. Tesco, the biggest loser points-wise on the FTSE 100. Marks & Spencer's down by nearly 7%. I read the statements this morning. I'm struggling to work out why we're seeing the drops that we're seeing.
Well, I think Anna really gave us a great context for what's going on. The consumer sentiment remains really weak, and it's weak going into this year. For example, Marks & Spencer's didn't sugarcoat it. They said the external environment remains challenging with cost and economic headwinds to navigate, For Tesco, which has got the highest market share since 2016, there's also this question, well, how much more headroom is there left to grow? One of the reasons why it did so well in terms of gaining market share is because its competitors were sort of asleep at the wheel a little bit, in particular Asda, which was taken over by private equity in 2021. Those companies, particularly Asda and Morrison, have already started slashing prices this year and are really going to give Tesco a run for its money. Marks & Spencer's, has also tried to reinvent itself as slightly more better value for money than before. How much more can it do of that?
Of course, they're also massive employers, these companies. Their employees are also consumers. Their consumers are workers. And we had this shocking report from the REC and KPMG about hiring falling dramatically because partly of the tax hikes in the budget putting up costs for companies. Was there anything about that in the outlook that we got this morning from the companies about jobs and wages?
Yeah, all the companies largely flagged this as an issue, that cost headwinds are going to be a problem. Greg's also touched on this. These national insurance contributions increases are going to pressure costs. So that's definitely what they're nervous about.
And leading to price rises?
I think it's hard to see how they balance the both. I don't think they'd say. We'll see after the journalists and the analyst calls whether anyone can pin them down on that. But it's
that's
hard
the fear,
to tell.
isn't it? That basically this leads ultimately, you're going to pass higher costs on to me in the form of NIC, then we're going to pass that on to the consumer in terms of higher prices, and that's the kind of
stagflation.
Precisely, the word that seems to be bandied around a lot at the moment. Dasha, great stuff. I'll look forward to those calls and the reporting that's going to follow on from them a little bit later on. What are we going to be talking about next? President Trump appears alongside a Dubai property mogul, Hussein Sejwani, to announce a $20 billion deal to build American data centres. We're going to talk to the DAMAC founder and chair next. This is a really fascinating conversation. Where does the money come from? How quickly can this company deliver on some of this? Obviously, there's huge demand for data centres at the moment. So I think some key questions surrounding this deal. When are we going to get some details? Hopefully in a few minutes' time.
When are we going to get some details? What are the politics around this? Remember, Donald Trump is on a little bit of a fundraising round when it comes to data centers around the United States. Most recently, also getting a little bit of extra funding as well from the founder of SoftBank. $100 billion there, and he, of course, is making the rounds, like I said, a little bit of a roadshow, an American data center roadshow that we are seeing. Like Guy said, we're going to be speaking to DAMAC founder and chairman next. Stick with us. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. Particular underperformance from the FTSE 250 this morning, down 0.7%. The FTSE 100 up 0.25%, and the broader stock 600 flat to the downside. But let's talk about the chip story. A parting shot from the Biden administration. It's planning further restrictions on the export of AI chips from the likes of Nvidia and AMD. This is a final push, really, to keep advanced technologies out of the hands of China and Russia. So we can get more detail now with Bloomberg's Jill Desis. Jill, what would these restrictions actually entail?
So really, Lizzie, the way that I'd look at this is it's kind of a tiered system that the U.S. is thinking about setting up here. The idea, of course, being, as you said, to keep AI chips out of data centers, particularly when it comes to U.S. adversaries like Russia and China. So the way that the tiered system would really work is there would be one tier, that first tier, which is more, as you're seeing on this map here, that blue tier there. That's the U.S. and its allies, so a lot of prominent democracies in Western Europe in particular. You see Japan, Taiwan on that list, and also, so they would have, freed use. That red zone there, you're looking at Russia and China in particular, absolutely no use of these types of chips. And then that yellow, orange zone, that's one that's more of, sort of that middle tier. And the way that that would work is that there would be some limited use that, those countries would be able to use for these types of chips. And then if they wanted to use more, sort of processing power involved in some of these really advanced chips, they'd have to apply to become become sort of validated end users, and so that would involve agreeing to certain types of acknowledgements, agreements with the U.S. over human rights, sorts of things, national security things, that sort of national security play. So that's the kind of system that's at least under discussion here.
Well, Jill, walk us through the response from the other side. We know Nvidia has had plenty of experience in these kind of export curbs. What are they saying this time around?
Yeah, Kriti, at this time, so obviously this is still something that's in the planning stages here. We did see actually Nvidia shares sort of dip a bit after, we reported this news. Nvidia itself has, come out with a statement and said that this isn't really the way that you would actually go around kind of, protecting these types of technologies. They don't really see this as, sort of that way you're looking at that statement right there saying, a last-minute rule restricting exports to most of the world would be a major shift in policy. It would threaten economic growth in U.S. leadership. And so certainly sort of coming out hard there. But again, I mean, this as we were talking about, this really does sort of represent that kind of parting shot from the Biden administration, as we've seen, several different types of restrictions, particularly when it comes to advanced technologies and chips over the last several years from this administration.
Jill Deesis in Hong Kong, thank you very much indeed. Let's stay with the chip theme and continue the conversation around what happens in the United States with the AI/chip narrative. Donald Trump announcing Tuesday that Dubai property group DAMAC will be investing $20 billion in new U.S. data centers. The president-elect unveiled the deal alongside DAMAC founder and chair Hussein Sajwani from Mar-a-Lago.
The first phase of the project will be in Texas, Arizona, Oklahoma, Louisiana, Ohio, Illinois, Michigan, and Indiana, those places. And Hussein, I'd love you to come up and say a few words. Thank you very much. Thank you. Thank you.
Thank you, Mr. President. It's been amazing news for me and my family when he was elected in November.
Hussein Sajwani, Mar-a-Lago, earlier on this week, now back in Dubai and joining us from there. Good morning. Thank you very much indeed for your time. Let's talk about the deal that was announced earlier on this week. A lot of details obviously still need to be ironed out, I suspect. But when are we going to see ground being broken? When are these data centers going to be built?
As you appreciate, the announcement is only less than 48 hours, where me and my team are working very hard. We had already some discussions with a number of landowners in different parts of the states. The team is working, and we hope sometime this year we'll be announcing some acquisitions of lands. And then, of course, we'll follow that design and construction. So there is a lot of work that we have to do to invest the $20 billion. $20
billion, that's a substantial amount of money. How are you funding this deal? Can you provide specific details on where that $20 billion is coming from?
As you appreciate, this is an asset-based business. It's an infrastructure. Normally, 60 to 70% you borrow from the banks or from financial institutions or bonds, leverage. DAMAC property will be able to put the equity, which will be in the range of the other 30%, which will be around $5 to $6 billion. DAMAC property's balance sheet today is capable of producing that money in the coming 4 years through its own resources. Having said that, if the opportunity increases and we get more opportunity, we'll be more than happy to bring third-party partners with us.
Hussein, it's Kriti in London. When you talk about those third-party partners, who are you talking about specifically? Are there banks, for example, that you have in mind?
We're already talking our first line is to talk to partners in U.S. who will bring added value if they are in the, construction business, they are in the land business, they are in the power business. So first we're looking at added value partner, not just to bring money, but to help us to execute in this business. That will be the first choice.
So, Hussein, part of this announcement was certain states that your investments are targeting, the likes of Michigan, Illinois, among others, Texas, for example. Are there specific players within those states that might help you get to those investment plans?
Indeed, indeed. I mean, we are open to all the options to execute the business plan from partners who are in the business or who will help grow the business.
When it comes to those kind of partnerships, though, is state funding something that we're talking about? We know that Donald Trump, for example, has already asked you to double the investment, not just keep it at $20 billion and go further. If you're talking about further investment in the United States, how much further? Do you have a number on that?
I don't have a number on that, but as you know, it's a market and it's an opportunity today with AI data center. As you appreciate, the business of data center is growing in more than double digit, and there is a huge growth there. So if we find the right opportunity, the right partners, I think we have the capability to take the business further beyond the 20 billion.
Hussein, good morning. It's Lizzy here in London as well. I know that the UAE has gone big on AI investments over the past couple of years. Will the government be helping in any way or backing this project?
No, we're not talking at the moment to any government backing. We're talking, as I said, to landowners and then to potential partners.
But is the Abu Dhabi government supporting you?
At the moment, we're not looking at any support from any government things. It's going to be very much commercial business plan.
Sorry, to clarify, are they aware?
Of course, everybody knows about it, and they're well aware of our intention to invest globally. As you appreciate, we have already a data center under construction in 3 countries in Asia, 3 countries in Europe, Middle East. We are in more than 10 countries around the world, covering Indonesia, Thailand, and Malaysia, Greece, Spain, and Italy coming next.
Hussein, in your press conference with Donald Trump, you specifically made the comment that you've been waiting for years to invest in the AI space in the United States. You specifically said you've been waiting for 4 years to invest in the AI space. Between the election of Donald Trump and the administration of Joe Biden, several of your other counterparts around the world have already been investing in AI in a big way. What has changed fundamentally to incentivize this move from you?
In the last 4 years, we have invested more than and committed about $2 billion in the private equity and in some direct deals, like we are investor in XAI, in OpenAI, in SpaceX, and we are in more than 60 funds in US. So we need not to stop investing, but we are investing through funds. Investing directly, we wanted to see a more friendly government who encourages the foreign investments. And we feel it's the right time now.
Hussein, just coming, there's a couple of quick questions. Just returning to the issue of funding. The funding is, you are 100% guaranteeing that the funding exists for this deal, that it's already in place, that you've secured that funding, that you are ready to go. That's my first quick question. Is that a yes or no answer? Is the funding in place?
The funding, our equity is in place. The debt will come as we go and as we build those data centers.
That brings me on to the second point. You say you're going to build them. Are you going to build them, or are you going to do the land deals and then let somebody else build them? Is that the way the model is going to work?
No, the model is we buy the land, we hire a designer, and then we hire a contractor who will build it, and then we lease it to the hyperscalers.
Hussein, speaking of the hyperscalers, are there customers that you have in mind when it comes to who may, at the end of the day, be some of the buyers of these data centers?
You mean the leasee? We're not going to sell the data center, but we're going to lease them. We're going to lease them to the hyperscaler, which are known Amazon, Microsoft, Google, Oracle, and some large Fortune 500 companies, IBM and others.
Have you started having those conversations with them?
We've been having conversation with them about Asia and Europe for the last 12 months, and we are quite advanced in negotiation with some of them to finalize a deal in part of where we have data centers already.
But when it comes to some of those negotiations, why not already have those investments in the United States, again, with the same players that you're working with in Asia and Europe as well? You made the comment of now having a friendlier government in place in the United States that is friendlier to foreign investment. Some would argue that's the exact opposite message that Donald Trump is giving. Why not invest in the U.S. earlier? Aren't you coming a little bit late to the game here?
No, we're not late in the game because this AI business already started only last 18 or 24 months. And we've been quite focused on Asia and Europe in the year 23, 24. And now our focus is going to be heavily on U.S.
Hussein, in terms of those potential customers, have you spoken to or met with Sam Altman and Elon Musk?
Yeah, we were together there at the New Year on the same, in Mar-a-Lago. And he's an amazing gentleman with a vision. And of course, his accomplishments. We are already investor in two of his companies, SpaceX and XI.
So that's Elon Musk. Have you met Sam Altman?
I met who?
Sam Altman?
No, I don't remember anybody like that.
All right, DAMAC's founder and chairman Hussein Zajwani, we will leave the conversation there. We thank you so much for your time and, of course, look forward to getting the updates on what that data center investment actually looks like. Some interesting comments there that he was talking about in terms of just where the investment is coming from. Already in talks with the hyperscalers, making it clear he's not speaking to the likes of Sam Altman, which, of course, we know the context for our global audience. Sam Altman and Elon Musk have both had very differing opinions on the creation of OpenAI. A fascinating time. I thought it was interesting that he said the U.S. government is now finally open to foreign investment. Weren't we just having this conversation with the likes of Nippon Steel and the conversation there that maybe they aren't open to foreign investment?
Well, that's the point. It's about to change. The government's about to change, and maybe it becomes more open. But that doesn't seem to be the narrative that maybe you get from the United. It's okay to invest into the United States if you are maybe within the orbit, and not investing in I guess you could argue that data centers are key technology. It's very muddled in terms of the narrative and the conclusions you can draw from both the Biden administration and also potentially from the incoming Trump administration.
A national security issue, of course, at play. I mean, it's going to be a fascinating one as we see what other international investors either dive into the States or maybe take us a little bit of a step back. Coming up, we're going to talk about a big factor of that, and that, of course, is going to be regulation. The outgoing chair of the SEC reflecting on his time in office as he prepares to step down, as we just discussed, Donald Trump returning to the White House. That conversation next. This is Bloomberg.
Welcome back. You're watching the opening trade 47 minutes into this Thursday session. Remember, the US is out today. We have the funeral of Jimmy Carter taking place a little bit later on. US equities, therefore, will not be trading. European equity markets largely becalmed, as you can see. We are seeing a bit of a difference when it comes to what is happening with the FTSE 100. The UK seems like a special case at the moment. Let's talk about the change of administration that we are seeing in the United States. The outgoing chair of the US Securities and Exchange Commission says there's still more to do in terms of regulating the crypto market. Gary Gensler will step down on January the 20th when Donald Trump is sworn in as the United States president. Speaking exclusively to Bloomberg, Gensler reflected on what he has achieved.
It's a great privilege to be in a role like this. I'm the 33rd chair, and it's a big country. A lot of people could do this job. So I start with it's just such a privilege to be here, and thank you to Joe Biden for asking me to do it. But what's remarkable about this role is it oversees the $120 trillion capital market, which touches everything in our economy, because you've got to raise money for most of what we do in our economy, and people save. So I feel terrific. And you ask about the attacks and things like that. That's what public policy is about. You walk into this central square and you debate these important things for 330 million Americans. I've worked over the years with Hillary Clinton on a number of campaigns, and I remember Hillary saying once, like, if you're not willing to be attacked, you can't go into the public square and debate policy. And so I think it's part of our great democracy.
I look at who is inveighing against you and who's throwing that invective, and it's the president-elect, it's the world's richest man. Does it feel different to you than what you, I'm sure, experienced after the global financial crisis when you were at the CFTC? Has the atmosphere, has the environment changed for regulators like yourself?
Well, I think it does change. What we do here at this great agency is look out for everyday Americans, people just trying to save for a better future and try to move through things that help them like we've done, like even shortening the settlement cycle from 2 days to 1 day. Might sound geeky behind the scenes, but it means you get your money 1 day faster, for instance. Or getting privacy notices. There was no federal rule that you needed to get a notice if your data was hacked, and we put in place some rules to do that. So we're looking out for everyday Americans, trying to lower the cost of the markets to trade stocks, to trade the bonds. But it doesn't surprise me that then there's some in the middle of the market. They're called brokers, they're called dealers, they're called intermediaries, stock exchanges, who they like their business model. And if we're changing the rules to benefit everyday Americans, they might have thoughts on that and object. And that's part of the process.
Outgoing SEC Chair Gary Gensler speaking to Bloomberg's David Gura about his legacy. If you were to think of words to describe Gensler, maybe polarizing would be one. Bloomberg's Valerie Teitel joining us around the table. Is that about right?
Look, I think he's going to go down as one of the most polarizing financial regulators in modern finance, to put that squarely to you. He is such a polarizing character. If we just take a look at his broader legacy outside of crypto, he's halved the settlement cycle for bonds, for equities. He's released new rules when it comes to corporate governments, reforms in the Treasury market when it comes to central clearing, and he's addressed some instabilities when it comes to money market funds. But his legacy is very much going to be down to his stance on crypto. It's defined much of his tenure as chairman, his very hawkish stance on the crypto market. And he very much used that exit interview yesterday to maybe have a last swipe at crypto, calling crypto rife with bad actors and calling it a field that was built off non-compliance. So that Gary Gensler interview yesterday, again, speaking very hawkishly when it comes to the crypto market. Trump's new pick for the SEC chairman, Paul Atkins, is widely expected to reverse a lot of his hostile stance on crypto, but is definitely going to go down with Gary Gensler's legacy as being a large crypto hawk that maybe has pulled back some innovation in this space. But I guess the future will tell us the history on crypto assets.
Well, crypto assets, but then in this kind of new administration under Donald Trump, we just had this interview with a latest foreign investor in the space. He's basically making the argument that regulation is completely going out the window. Is that being priced into the markets here, that this is kind of opening the floodgates to funding when it comes to the bond market, the equity market, et cetera?
Well, look, Michael Barr stepping down as vice chair for supervision does open up another discussion on what's ahead for banking regulation. He really very much pushed tougher rules when it comes to capital stances. And since his resignation, we've already seen some movement in asset swaps that have shown that some banks out there have taken this guide that those capital rules will be relaxed and they'll be allowed to take a bit more risk, hold more risk on their balance sheet. We've seen that move in asset swaps. It's kind of mirrored or kind of maybe given us a signal that banks view what's to come under Trump as positive for their risk-taking.
So that juices the economy further, right?
Juices the economy, juices those Treasury yields, and perhaps pushing another leg up in Treasury yields. Again, it's not going to be, I guess, easy for the globe to handle at this rate.
Well, yeah, on that point, Val, let's, while we've got you, just talk about gilts, because the picture seems to have brightened a little when it comes to the 2-year high at 1 basis point now, the 10-year high at 3 basis points, but the pound's still weaker and the FTSE 250 still down. Can Reeves chill?
Look, it is early days when it comes to the session. Let's see what happens later in the day. But a back-to-back session of a double-digit basis point move in the 30-year gilt is not something that anybody wants to see in terms of calming the market down. It looks like we've maybe hit a bit of calm, but don't remember, we've got non-farm payrolls on Friday, a hot NFP print tempting us to believe that the U.S. economy is still on a good track, could push the bond route further in Treasuries and then have maybe a knock-on effect on gilts. But it's definitely, caught the market's eye on an international scale, and I don't think this theme is going to be put to bed by anything we hear from Rachel Reeves.
All right, Bloomberg's Valerie Teitel walking us through that bond market story, taking us on a little bit of a tour around the world. Look, there is a lot going on later today as well. We do know that I believe that the bond market over in the States has an early close. That, of course, because of Jimmy Carter's funeral. The U.S. cash equity markets are closed as well today. But then you do have some Fed speak, some BOE speak as well. 2:05 p.m. UK time, Fed's Collins speaking, and then, of course, at 4 p.m. The BOE's Breeden speaking as well. But it comes right back to, I think, what will be the main event in the States today, which is Jimmy Carter's funeral, his legacy, of course, a one that is hanging large, especially in the here and now, talking about the kind of state of play around Panama, Iran, Russia, et cetera, not to mention just the time and the interest rate story and the economic story he had to deal with that we are seeing echoes of at the moment.
He won the Nobel Peace Prize. He was the president of the United States. He was a submariner. He was a naval officer. He had a storied career, 24 to 24, basically, which is an incredible life. And he did so much within it. He will obviously be remembered for a number of key events. The late 70s were a really difficult period for the United States. As you pointed out a little bit earlier on, he was a one-term president, but he had a lot to deal with within that presidency. There was an awful lot going on, from what was happening with the energy crisis to what was happening with Iran.
And an incredible life even after office, even if it was just one term.
Yeah, the Habitat for Humanity story, and of course a lot of the vaccinations globally due to his and his wife's foundation as well. We'll just take you through the live pictures that we're seeing right now in Washington, where of course Jimmy Carter has been placed for the moment, and this is going to be among a full day in the state of coverage from Bloomberg Television. We do have special coverage over in Washington. It will begin at 5 p.m. London time on Bloomberg TV and radio. There will be a funeral service at the National Cathedral, and then a departure from the cathedral to the Joint Base Andrews as well. Ultimately, a arrival at Lawson Army Airfield, where he will then have a funeral service back in Plains, Georgia, where, of course, he and his foundation are based, and his family was based as well. And I should mention, Guy mentioned that he had a storied career in politics. He was also the governor of Arkansas, so, of course, very much a domestic story, a state story as well. Again, looking at live pictures in Washington of Jimmy Carter ahead of his state funeral. This is Bloomberg.